Good evening and welcome to the property edition of Your Money, Your Call. I'm Michael Teys. It was another strong weekend for the two major Australian residential property markets. Australian property monitors have released results for auctions in Sydney for the weekend, showing 434 auctions with a clearance rate of 82.7%. More properties were put to the market in Melbourne, where a clearance rate of 73.9% was reached from 1,319 auctions. This compared to 65.6% for the same time last year from a fewer number of properties. The strong property conditions across key capital city areas have been a catalyst to provide a knock-on effect for some of Australia's regional property markets, with reports today from RP Data showing increases in the property values across several regions. Senior research analyst at RP Data, Cameron Cusher, says overall the challenge will be rising levels of unemployment, which can be more detrimental to less diversified regional economies than to the capital city markets. On a positive note, he says that with mortgage rates tipped to remain low and talk that the Australian dollar will continue to fall, the attractiveness of housing is likely to continue to show further growth over 2014. The Australian carried a story over the weekend about foreigners splurging on houses based on new data from the Foreign Investment Review Board. Offshore buyers bought a record 5,091 established homes worth $5.4 billion last financial year, compared with just 647 properties worth $810 million in 2009-2010. A further 4,499 new apartments and homes worth $2.9 billion were sold to foreigners off the plan last financial year, more than double the investment recorded 3 years earlier. Nearly half the established home sales were in Melbourne and Sydney, where Asian buyers have been targeting properties close to the CBD and on Sydney's North Shore. Chinese buyers poured $5.9 billion into property investment last financial year, topping the list of foreign buyers. Collier's International Asian Director of Investment Sales, Seem Luong, said China's ban on owning more than one investment property was fueling demand for Australian real estate, including vacant land. John McGrath, founder and chief executive of McGrath's Estate Agents, said Asian buyers prefer new units, but were also buying expensive homes on Sydney's North Shore. He said a lot of purchases are associated with education and people migrating to Australia. New homes and units are an easy passage into the Australian market. Well, with me tonight to discuss these and other matters are Damien Collins of Momentum Wealth and Brad Beer from BMT. Both regulars to the show. Welcome back, Brad and Damien.
Pleasure, Michael.
Now, the news tonight about foreign investment, what does that mean for our markets? Let's have a little talk about that. Firstly, Damien, in Perth, what's happening with the foreign investment there?
Michael, we do see foreign investors, but it's not so much the mainland Chinese. We do get a lot in Perth from Singapore, Malaysia and Indonesia, and again, a lot of it is around education. So people buying properties, they're going to migrate, or their children are going to go to university as well.
Is there a preference to houses or units?
Certainly from an investment point of view, they're very much into the units. That's obviously coming from Singapore and those locations, that's the dominant supply style. If they're coming to more live long term, they tend to more favour houses, just because they can get land, which they often can't in Singapore. But look, overall, there's a bit of this thing out there about foreigners are pushing up prices. In the scheme of things, all those numbers, that's still a small percentage of the market, and I don't think foreigners are really having an impact, but it's not significant in my opinion.
Brad, what are your thoughts with other parts of Australia?
Well, look, I think here, especially in Sydney, that there's probably a little bit more of a percentage of foreign buyers, especially in units and especially in new units, and those numbers that you're talking about there definitely demonstrate that. I'm seeing it on projects where we work on depreciation up front, and the buyers, there's definitely a lot more Chinese involved, especially Chinese and foreign buyers. And I think that does have the ability to push probably a little bit here, a bit more than you're probably seeing in WA, to push the prices a little bit and make it a little bit harder for that owner-occupier to get into the market sometimes, I think.
It'll also be interesting to see what it does to vacancy rates, because some of these foreign buyers won't be as concerned about tenanting the property as a domestic buyer might be.
And so therefore, it's not creating a situation where we have a whole lot of vacant property. So it's not necessarily so bad as an investor, because it's not like you're fighting with everybody else for the amount of tenants that do exist to rent the property.
And not to put doom and gloom on the agenda, but to put doom and gloom on the agenda, what's the risk to these numbers and to the burgeoning markets that we're seeing around the country?
Look, I think the risk is that if they lose the appetite for that property and they've pushed prices at all or pushed the demand so that there's not as much supply available to the Australian buyer, be it the investor or the owner-occupier, that if they lose the wish to buy so much of it, then we come to a situation where they're not taking up the supply as much as they are now. They're probably pushing prices in Sydney a bit more than I see in WA, and that's a bit more of I suppose, of a concern if they don't continue to have the appetite for it.
I think, like Cameron Cusher says from RP Data, we've got to watch the unemployment figure too. Sitting up at 6%, it's heading up, and I think if there's an effect on the market, it'll be that for sure. Well, let's take our first email, and I think it's one for you, Brad. It's from Gurav, and he has a question on depreciation. Hi, Margaret. Can you please advise on depreciation for an investment property? I'm planning to purchase an old house, probably from an investor, and while researching I found that if a house is older than a certain age, there may be no depreciation available for the house. Also, if an investor has already been claiming depreciation on the house, then I can only claim for the remainder. Can you please clarify?
Michael, that's probably definitely one of my questions.
You've written all over it, right?
Depreciation written all over it, and that's my expertise. So with an old house, look, the depreciation is often not as much. Any property potentially has some depreciation available. There is definitely an important date. If it's been built before 1987 these days, you don't get to claim as part of the structure of that building. But there'll still be some what we call plant items available to make some claims on. So we'll have a look at the particular property and give an indication of what sort of deductions might be there. You'd be surprised on some old properties. I know I've done some of Margaret's older properties, and she's told me I don't think it'll be worth it, Brad, and she's actually got some deductions out of them. But we'll always have a look and make sure it's worth it before we go ahead. And also, if you're buying something that's been built sort of, early 80s or before, a lot of things have been replaced, may have had some renovations, and there might be some depreciation available to those things. In relation to looking what the previous owners may have claimed, if you buy older properties, they're not new, so you're not getting to put new values on these items. So we've got to sort of look at second-hand value on these items all the time, and depending on the situation in the purchase, it'll impact on how that affects you particularly, but it's always a question of let us look at the property you're thinking about buying and crunch some numbers on what sort of deductions might be there, which we can do really easily with a few photos or an address of the property and a bit of information, and get an indication of what the dollars are before you think about buying that property.
And Damien, you're advising purchasers all the time and investors. How important is it to get that depreciation dollar, and does it go to the heart of your recommendation about what people should be buying in terms of whether it's a new property or an old property?
I think if you're going to buy an investment property, you definitely want to get a depreciation schedule. You don't know what you can depreciate. Your accountant is sitting in their office, not visiting the property. They're not going to know exactly what you can depreciate because they're not there. So we always recommend to our clients that they should get a depreciation report. In terms of the investment decision, no, it doesn't drive. We're looking at, obviously, rental yields, capital growth potential. We don't push people into new. Yes, you get more depreciation, but obviously there's potentially less land value and potentially some less capital appreciation. So it's very much for us client-based. What is the client after? Depreciation certainly isn't important to the cash flow, but it's just part of the measure of investment property, not the key benefit.
Yeah, and I would add to that people investing in new properties, particularly apartments, do have to be concerned about building defects and other issues that affect a property as it's settling down. So sometimes what you see is what you get can be a better proposition, can't it?
Yeah. And look, just on definitely what Brad was saying, that we've seen properties where clients think, oh, there's no depreciation. Well, a carport might have been put in 10 years ago. And
there'll be something
That's
there.
$10,000. That's $400 a year depreciation at 2.5%. So.
Brad?
Look, I think depreciation is something that is something that relates to the cash flow, but there's so many other important decisions. Like, I'm the depreciation guy. There's so many other important things about your property investment.
It's always a case of don't let tax drive the deal.
Don't let tax depreciation drive the decision, yeah.
Well, thanks for tuning in, and don't forget that this week, as usual, we're continuing with our question of the week. And this is your chance to get hold of one of Margaret's books. Every Monday night, the panel and I choose one question from either the emails or calls. And this week, the best email or call will receive How to Achieve Property Success. All you have to do is call us on 1300 30 34 35 or email property@skynews.com.au with a question. Then make sure you're watching at the end of the show to see if you're the lucky winner. We'll take a short break now. When we come back, we'll take some more of your calls and emails. Welcome back. I'm Michael Teys, and joining me tonight are Damien Collins of Momentum Wealth and Brad Beer from BMT. We've been chatting about all things property. If you have a question, grab the phone and call us on 1300 30 34 35, or you can email us on property@skynews.com.au. Well, gentlemen, while we're waiting for people to work out who's won the Oscars and turn over to talk to us, let's take an email from Manpreet. He's asked about whether or not to borrow from a builder who's going to pay a deposit. So his email says, we are thinking to buy a property in a western suburb in Melbourne, but we don't have the upfront deposit to get a home loan. A building company is offering us $2,000 deposit to buy the land and house. Is this a wise thing? Well, Damien, let's start with you. What do you think about someone coming in and saying to you that they've got a builder and obviously they're in pretty modest financial circumstances? We've got a builder offering a loan for a deposit. What are your views on that?
Manpreet, I wouldn't be making a home purchase decision on a $2,000 incentive that the builder is going to give you. And in fact, reading your email there, you mentioned you don't have much of a deposit. Now, lenders generally are going to lend 95%. You're still going to have to come up with 5%. In Victoria, you'll get on a new property $10,000 in first home owner grants. But I guess I'm concerned you haven't saved anything yourself. The builder, $2,000 may or may not get you over the line, but I'd certainly wouldn't be making my purchase decision on that basis. And I think that's obviously a scary tactic. If someone's offering you some incentive to take their property, well, there's obviously a good reason they can't, potentially sell it for what it's worth. And so no, I wouldn't be making a decision based on that at all.
Yeah, it's interesting to see the incentives come rolling around, isn't it? You can almost pick it in a market, and now's about the time when there's been, some movement, and people are starting perhaps to develop things that aren't stacking up just against the competition. You'll often see these incentives thrown into the mix to make something stand out from the pack. Brad, you've not got any grey hair at all, but I'm thinking...
couple coming through.
I think you've seen a couple of these in your time. What are your thoughts on incentives generally?
Look, and I would say at $2,000 in the purchase of a house, do not... just count that purchase price as $2,000 difference to otherwise, and you need to have a really serious look at the fundamental investment. It's like anything with incentives. It's about what you're buying. It's the actual property. It's the actual fundamentals of why you're buying that property. And instead of $398,000, it's $396,000. That's the only way to look at that $2,000. Do not purchase based on that being the reason. If you can't pull the money together to make the deposit, then how are we going to go at settlement with the rest of that money or everything else that we need to actually do? And it's a zero reason for that. It's $2,000 difference in purchase price. It's the only way I see it.
Yeah, and that's a good point about the other costs of purchasing a property. Damien, what advice do you give people when they come to you in terms of what they need to have available to them for the other costs, the exorbitantly expensive depreciation consultants and people like this that need to be fed?
A great value for money buyer's agency fee as well, and all those sort of costs.
Of that. What sort of money are we looking at to buy a property?
Putting aside first-home buyers, obviously, I'm assuming he was a first-home buyer in that case. But if you're not a first-home buyer, generally you need 5% as a minimum deposit, and lenders are generally lending to 95%, and they'll let you capitalise the lender's mortgage insurance on top of that. So if we're talking about a $500,000 property, there's $25,000. Certainly, you're going to pay stamp duty, which is depending on the state, could be another $20,000-ish on top of that. So really, again, if you're looking then using other consultants as well, you're not going to get much change out of $50,000 to get into a property. So obviously, for a lot of people, it's a bit to save. If you've got equity in another property, you might be able to do that. But in this particular case, with no savings and no history of savings, that would be a concern for me. If you can't demonstrate you can save money, I don't think you should be buying a property.
Look, I know I haven't bought much in the recent times, but I did buy one late last year, a property, and I still remember being surprised. And I know, and I had the cash to cover these things out of offsets or otherwise, and still remembering at the time it come to settlement, this much for this. I was like, oh, that's a lot more money than I kind of remembered. But I know it was there, and I know
like going
I had
overseas,
cash to cover
isn't it?
Yeah.
Take twice the money you thought.
Yeah, and then come back with a big credit card bill.
Yeah. I was reading this morning about another form of incentive, which of course is the NRAS scheme, the National Rental Affordability Scheme. And there was a story this morning that talked about how that's being used by universities to fund student or to make it easier for investors to buy student accommodation, which was really, of course, not the intent of that scheme. That scheme was about helping people who were key workers in the cities, ambulance drivers and teachers and other people that finding it hard to live close to or close in the big cities to help lower the rent. But that's an investment scheme that's been bandied around as well, which has the same effect, doesn't it? It encourages people to look at properties perhaps they might not have looked at otherwise, or to buy a property when they might not. Brad, are you seeing NRAS properties sold in any great number at the moment?
Look, we do a lot of depreciation schedules for NRAS properties because we're not involved in the purchase decision. It's later on, and we're seeing them come through later. But I still think, like any scheme, now NRAS has got some positives about it as far as the way it actually works, but you still have to look at the fundamental underlying investment. It should be about the property, about the reasons why you would buy that property. It's like depreciation isn't after you buy it. It's better for cash flow, and think about that as part of crunching your numbers. But an NRAS is kind of like that. You've still got to make capital growth from this property. You've still got to have tenants. The NRAS scheme will help you on cash flow for a period of time, but if you don't get the growth because you've paid more because it has that in place, it won't create the wealth that you're looking to create through property over time.
So Manpreet, back to your situation, the panel's advising you to be very careful about making your investment decision based on this free lunch. In property investing there is no such thing as a free lunch, and for other viewers, the free lunch in property can take many different forms. It can be a rent guarantee on an investment unit that might be being used as a service apartment. It can be some sort of tax concession that is being offered by a state government looking to accelerate a market. So be very careful of all of those things and look to the fundamentals. Well, it's time now to take another break. But if you have a question rather, call us and you may get a copy of Margaret's book, How to Achieve Property Success, if we read out your question and select you as the winner. You can call us on 1300 30 34 35 or email property@skynews.com.au and make sure you're watching later to see if you're the person we've selected. We'll be right back. Welcome back to Your Money, Your Call. This evening I have with me Damien Collins of Momentum Wealth and Brad Beer from BMT, who are doing a great job answering your emails. So you can call us with a question as well if you like on 1300 30 34 35, or you can email us on property@skynews.com.au. Well, now we've got a question from a viewer concerning property management fees, and we were talking just before about the cost of ownership. This question goes to the cost of holding a property. The question reads, I have a question in regards to property management in Perth. From my findings, the fees are around 10% to 15%, including inspection. I find these fees to be extremely high, making me reluctant to enter the Perth market. I would like to know, is this the fee that you are paying too, and is there any other way? And that question comes to us from Ellis. Well, Damien, Perth is your hometown, although you claim to be a Victorian by birth. But nevertheless, I'll get you to comment, if you would, first of all, on property management fees in Perth, and perhaps we'll talk then about how they relate to the market there, plus other fees around the country.
Alice, look, property management fees in Perth are more expensive. There's a couple of reasons for that. I wish it was all the agents making lots of money, but it's certainly not. Agents generally make about the same around Australia. The reasons for the higher property management fees are the wages in Perth are generally higher. Your property managers are paid more. Also, the laws are more complex, more pro-tenant. There's a lot of things that a property manager has to do, and all those things lead to a smaller number of properties that are managed by the average property manager. We find in Perth it'll be 100 to 120 properties per property manager, while you find on the East Coast it's somewhere up to, sometimes up to 200. So all those things go to property management fees being more expensive. But if you look at it on this basis, let's say your property management fees were 50%. Now that's a big number, higher than they were in Melbourne or Sydney. Still, from 10% to 15%, we're talking about 0.25% of the property's value. So in the scheme of things, it's a very small amount. If you're going to buy a good investment property that's going to generate you strong capital growth, 0.2% a year or thereabouts is a pretty small difference. So I wouldn't be making my investment decisions based on the property management fees. Again, like we spoke before, depreciation is a part of your investment decision. It's not the most important, and again, your property management fees are not the most important part of your investment decision of where you're buying. And as I say, Perth, yeah, a bit more expensive, but in the scheme of things, not that big.
Yeah, I agree. Brad, you're an investor in your own right. What are your views on what you should pay for property management?
Well, in talking to Damien, especially being in Perth in that industry, I know that it's not like there's one guy charging 10 to 15% and everybody else is charging 7%. So these guys do have to compete in this marketplace. Now, I don't think there's like a conspiracy or a cartel going on here that allows them to, or what's the word? I think cartel's the wrong word, but where they've all conspired to charge this much money. Someone would come into that market and charge less if they could actually work out to make that a profitable business, to run that situation. I believe property management fees, I have property managers manage my properties, and you could argue that the dollars per week, we question whether or not you could do that yourself, but I believe it's worth it because I want them to make sure the rent is collected. I don't want to have a relationship with my tenant because I'm probably going to be too nice to them when they don't want to pay. I want these guys to make sure they collect the money. I also believe that it shouldn't be the reason for an investment decision. Margaret and I will often have a debate about, for example, land tax. I pay too much in New South Wales, and I do, but I see that as a cost that I have to factor in when I buy a property in New South Wales. Don't love it, makes me look out of the state sometimes, but as a cost that I know, and I know it's there. Still, I'll go back to you've got to look at the fundamental investment, the fundamental property that you're thinking about buying, and assume that the fact that it's going to cost you a little bit more to manage it there. I've got to put land tax into mine, etc., and go, does it still stack based on all these things, and then make the decision accordingly.
But head to head, from the west at 10 to 15, what are we looking at on the east coast?
Well, a lot of mine I pay 7, 7.7, 8.8, and I don't own property in Perth, so I don't pay those fees that are higher.
But it's relative, as you say, to what people in the town are
paying.
And it should not be the basis of Ellis deciding to invest in Perth or not. There's a whole host of other issues that need to be taken into account, which are far more important.
And I guess that is the point. Don't make the decision just based on the fact that you think they're high, unless... I mean, if you want to go to a different property manager and they're 7 and they're 15, then there's something going wrong. But they're all that, so there's got to be a reason for that.
Damien, what are the questions people should ask about property managers, about property management services, rather than focusing on the fees?
It's one of the things we often see. People go, "What are your fees? What are your fees?" Like property management is a commodity; everyone's the same level of service. So, a couple of the questions I'd always recommend asking. Of course, you want to know what the price is, but how often do you do rent reviews on your property? Some property managers will just put a tenant in there, and if they roll over to periodic, they just leave them at the same rate. They don't regularly review the market rents. How many properties are you managing? That's a really important factor as well, because if a property manager is managing too many, guess what? The service level goes down.
The key question,
you don't put up the rents. So really focus on what you get for your money, not just about the price.
Well, this is Your Money, Your Call, and we're about to take a break, but when we return, you'll have another chance to get hold of a copy of How to Achieve Property Success by calling us now on 1300 30 34 35 or emailing us on property@skynews.com.au. Thanks for joining me tonight. I'm Michael Teys, and with me tonight are regular panellists Damien Collins of Momentum Wealth and Brad Beer from BMT. If you've got a question, you can call us on 1300 30 34 35 or email us on property@skynews.com.au. We'll take a question now from a viewer, Christy, and Christy writes, "Hi, I think I've made a typical mistake when starting out. I have 3 properties and they're all negatively geared, which means I've hit my borrowing cap and therefore hit a wall for investing. I've since learnt the importance of investing in positively geared property. What steps do I need to take from here to get positively geared property so I have cash flow to keep going?" So that question comes from Christy. Damien, let's start with you on the whole issue of positive gearing versus negative gearing, and you might explain for people that are watching perhaps for the first time the difference between those two concepts and how important they are to investors.
So Christy, and for the viewers, so negative gearing is effectively where the expenses on your property are more than the income you receive, and from that you get to claim it back on in your tax return as a deduction against your other income, and you'll get some of that back in terms of a tax refund. Obviously also in that there is depreciation, which is a non-cash deduction, which can also help you with your with the amount of tax that you pay. Positively geared, and it's been one of the hot topics around in property, particularly over in the West Coast in the Pilbara, which I'll get to in a second, is obviously where the property is, you're getting more income than you are your expenses, including obviously any depreciation cash back, and so it's positively geared, not costing you money out of your pocket. Now, I want all my properties to be positively geared. I don't choose negative gearing, but what I do choose is I choose properties that I think will outperform the market, because you get rich in property from capital growth. So I start at that point looking for properties that are going to outperform, and from there I want to look at the ways I can get them to positive gearing as soon as possible. I don't just go and buy positively geared properties, because there's a reason why they're positively geared from day one. A couple of things. They're in, for example, mining towns. People thought that was the way to riches. They bought properties getting 10% yields in Port Hedland and Karratha in the west, obviously in the Queensland mining towns. They thought it was a ticket to freedom. Guess what? The rents in the Pilbara and some of the Queensland mining towns are down 40%. There's a reason you get higher yields in those locations, is because there's higher risk. Or the other area where you might get higher yields on residential properties is where people think there's perceived lower growth. So there's always a trade-off. There's no magic panacea to an investment property. So what I'd be looking at is, what can I do to get my properties to be closer to positive gearing? Things like refurbishing the properties, perhaps you can get better rental yields. Furnishing properties in certain suburbs and certain types of properties can be another way. They're the sorts of things, granny flats, you might be able to, if the properties are in Sydney. Just look at other ways. Don't just focus on your next property to be positively geared just for the sake of it. It's still got to be a good growth property.
Thanks, Damien. There's some good advice there for Christy to turn her portfolio around. Well, we've got a caller now on the line from Melbourne, and Julie, you're calling us to talk about a Sydney investment property, is that right?
Yes, I'm interested in the panel's views on what's happening in Western Sydney. I've been looking in the area for about a year, watching the prices go up and up, and I wonder if I have missed the opportunity to buy in at a reasonable price. Just want the panel's views on what might happen in the inner west in the coming 12 months, and whether the panel has a view about any particular suburbs that might be better value, for example, Ashfield or Dulwich Hill.
Okay, thanks, Julie. Well, Julie is all across Western Sydney, and she's talking about the inner west as well as what we might call middle or outer west as well. So, Brad, let's start with you, being a Sydney-sider. What do we think about the Western Sydney investment property market? Has it had its run?
Look, for the last quite a few months, and Julie, as you said, you've been seeing this happen. You know, people I talk to that have been trying to buy property in those areas are getting cut out by everyone else trying to buy those properties. Now, we had a discussion earlier on the show about, you know, foreign buyers coming in and buying this property, making this market hot. You know, maybe they haven't pushed prices ridiculously, but there's definitely going to be some pressures on pricing, and they will push pricing. I suppose one piece of suggestion would be a little bit of hindsight here, so it's too late. If you think it's right, you think it's going to go and move, then it's probably time to make some decisions instead of hanging on for so long sometimes. We've had a fair bit of a run here. We've had a fair bit of run in values. We've got to be, I suppose, considerate of the the amount of especially Chinese or other overseas investment coming in and making sure there's still a flavour there, so you've got to keep an eye on that. Interest rates are still low. I don't think they're going high really quickly. We've had a bit of run. Would I buy here now? I haven't bought anything lately. I'm not necessarily looking at that market either, but it's going to be difficult because you have to fight with so many people at the moment to actually buy something. So it's not my flavour right now, I guess, would be the answer.
Yeah, I think we're just at that tipping point, aren't we, where some of the commentators are just starting to say, well, look, there's certainly parts of Western Sydney that have been overcooked, and there are other parts that are okay. Damien, what are your views on this market here?
Yeah, Julie, Sydney, as you know, has had a very good run. I still think it's got a bit of legs to it, but when you get into this sort of market where people are in some cases overpaying, where there's multiple buyers, that's where it can really start to get at the frothy end of the market. So look, you might get some growth in the next 12 months, but then I think after that you might be back to more normal cycles. Now, Sydney has had a long period of flat before this recent relatively good rise. Maybe you want to look at Brisbane. I think that's a market that certainly is in the early stages of an upswing. It's lagged behind the Sydney and Melbourne and even Perth as well. I think Brisbane, if you want to look outside your own area, that'd be the place I'd be looking.
Yeah, look, I agree with that. I think, Julie, with Sydney, I think it's time to go back to the fundamentals and start with that basic bellwether of investment, supply and demand fundamentals, and that is the vacancy rates. Look at that, see where they're sitting. 1% means that there's an undersupply, 6% means there's an oversupply, and just see where you sit in that, and then look at the other things that we always talk about on this program. What is its proximity to transport, to shopping facilities, to medical centres, to education facilities and other things that make these places desirable for people to live in. I think it's important when looking at the Sydney market to realise that this is a big town, and whilst we're talking about tonight foreign investment driving North Shore prices and CBD prices, they're not necessarily investing in the West. They're more likely to invest closer to the city, but it's a big market, and so we can be seeing big clearance rates and lots of activity at the top end of the market, and at the investment property end there could easily be oversupply. So be careful about Western Sydney at the moment. There are parts that are worth looking at and parts that have had their day. I agree with Damien about Brisbane. Brisbane has got legs at the moment for sure, and there seems to be a good couple of years ahead for the Brisbane market. So it might be time to go further north and to put your toe into that market as well. So good luck with your investing decision, Julie. Now, thanks for being with us so far. We're going to go off for a short break, but when we return, you'll have another chance to ask your questions simply by calling us on 1300 30 34 35 or emailing us on property@skynews.com.au. Welcome back. I'm Michael Teys, and with me tonight on my expert panel and taking your calls are Damien Collins of Momentum Wealth and Brad Beer from BMT. If you have a question, you still have time to call us on 1300 30 34 35 or email us on property@skynews.com.au. We've got a viewer email now from John, and John writes, "Hi Margaret, I've developed 3 townhouses in St Albans, Melbourne with the intention to sell. I claimed the GST totalling $45,000, but due to the low market have decided to rent them for now. How do I stand with the GST?" All right, well, Damien, we might start with you on this one. GST.
Yes, and my reformed accountant had I shall put on. So what happens is, as you mentioned, when you're developing and you're intending to sell, you claim the GST on the construction as you're going through the project, and once you sell the properties, you then pay GST at the end, generally on the margin scheme. Now, what happens is when you change your intention, the ATO don't like that because you've claimed all that GST back, and now you're sitting with those properties as rentals. If you're still actively marketing the properties for sale, you can still defer it potentially and show that you actually are marketing for sale. You're just putting tenants in to help with the rental income and the holding costs while you're there. But if you actually are renting them out with no marketing plan whatsoever, you're going to need to pay that GST back. So I'd be contacting your accountant and making plans to find that money, because if you are renting them with no intention to sell, you will have to refund that GST back to the ATO.
Is there any time frame on that, Damien? Or?
Well, once your intention has changed in the next BAS in the next quarter, you definitely need to make that change.
So you can't just sort of wait for the ATO to tap you on the shoulder.
Not unless you want to pay a lot of penalties, you shouldn't do that. No,
Yeah.
definitely.
So
definitely
as soon as you've made the decision and taken the advice, time to put your hand up and find that money.
Yeah, exactly. And if you've got no marketing plan, you're not actively marketing them, then you definitely need to pay that back straight away.
Yeah. So it's another, I suppose, hidden trap, I suppose, of developing, isn't it? If things change, then the equation, the cash flow changes.
Well, and a lot of people don't think about it. They think the GST, now depending on your bank funder, some bank for 3 townhouses you mentioned, you might have just got traditional residential funding, so you might have got to keep all the GST back in your own pocket. In the bigger commercial deals, the lenders typically make you put that in a particular bank account. But so in this case, he may well have spent it. So he might need to go and get some refinancing, get some of that equity out to pay for the GST.
All right. Brad?
Always need to consider, I guess, with margin screen that it's like a part of the feasibility study that if things do change, if the market changes, if I can't sell them for this price, you're really always going to have a pessimistic scenario there for what if the worst case scenario did happen and can I still support this?
It makes the point, doesn't it, that when you're an investor you really need to decide, are you going to be an aggressive, proactive, value-add type investor who's going to do some development? Or are you going to be more passive and take the built property and sit?
Yeah, and look, I've done a little bit of both, but when I've bought something for the purpose of development in some way, it's always been I'm a property investor first, and I'm looking at the potential for development, but I'm not forced to develop because I've kind of got plenty of other things to do in my life and run a business, and if they stack but make sure they stack obviously before I buy something, but do that with if I don't do it, I'm not forced to do it. So if the market doesn't allow me to be able to do this development, then what's pessimistic? What happens? Can I just hang on to this as a property investment anyway?
Yeah. All right. Well, our next email is a question about buying off the plan in Sydney. Hi Margaret and panel. I bought off the plan a one bed in Sydney CBD a couple of years ago for $580,000, but due to moving away from Sydney for work, I'll not be able to live in it when it completes in September. Should I sell it before it completes and make a slight profit, or should I leave it as an investment property? I'm worried about an oversupply of apartments in Sydney CBD. Let's firstly have a look at the question of oversupply, Brad. Is there any evidence of oversupply of apartments in the Sydney CBD at the moment?
I wouldn't be highly concerned about an oversupply of apartments in the CBD. You know, we talk about foreign investment pushing market prices, and we tend to generally make the mistake around here of probably building too much over time when we do have a hot market, but we're not there yet. We've had an undersupply for a period of time, and you've got to get projects approved through councils and then go and build them before you'll ever create any oversupply problem. And we're talking about September. I think that on the concept of should I sell it or should I not sell it, have a look at the crunching the numbers on what it's going to cost to own it. What do you believe now? If you were to buy that as an investment now, would you buy that if it's going to settle in September? Find out what your rent may be, do those things, obviously a good depreciation schedule and things like that. The difference for you is, as a purchaser who's already actually committed to this, you've got to look at it versus selling it as opposed to versus not buying it.
Yeah.
And the cost of you selling and changing that decision is something you need to factor into your decision on whether you'll keep or sell this investment.
That's right. And I think oversupply stories can come from taxi drivers, they can come from people at barbecues, it can be somebody listening to us talking about Western Sydney or indeed Melbourne, where there really is an oversupply of apartments looming in the Melbourne CBD, and they'll hear apartments, CBD, oversupply, and all of a sudden it's no good and we're all in trouble. So a cautionary tale there to really focus on the fact that there are markets within markets. And because there might be an oversupply of apartments in Melbourne, in the CBD, then that doesn't necessarily follow in Sydney. And in fact, I would have thought in Sydney at the moment there's no such thing as an oversupply in the CBD. It's difficult to find land. It's incredibly difficult to get approvals to build. The restrictions on what can be built are much more significant than, for example, Melbourne. And perhaps that's one of the reasons why there's not an oversupply of Sydney CBD apartments at the moment. Damien, do you have anything you'd like to add to our viewer's question?
Oh, look, apartments, as both Michael and Brad mentioned, in Sydney there really isn't an oversupply at the moment. Historically, though, in apartments market, certainly when a market gets hot, that end of the market, inner city, high-rise, where you can put up hundreds of apartments in small locations, tend to be a market that does get oversupplied. It's not there now, and certainly to get a project off the ground of that scale, you're talking 3-4 years potentially even to get it if you started now. So, look, there may well be an oversupply in 2 or 3 years if the market cools down, all that investment demand dries up and the construction starts, but there's certainly not one now. And all the other stuff around your question is really a personal question. We don't know enough about your financial circumstances, how much profit is there. You mentioned you paid $580, you didn't say what it's worth now, what you think you might sell it for. So I'd recommend you go and get some advice. What else are you going to do with that money? You're going to put it in the bank, or you're going to buy another property. All those other things come into that equation. But certainly from an oversupply point of view, I think it's not happening now in Sydney.
It raises the point, doesn't it, about the short-term nature of people's perspective on property. I mean, if you're buying an apartment if you bought an apartment off the plan 2 years ago, yet to settle, it'd have to be something quite drastic happening, wouldn't it, before you take the hit and sell that, having committed to that investment opportunity. I would have thought something bought off the plan 2 years ago in Sydney and settling in September is a pretty good bet.
Yeah, you should, unless you bought really badly, then given what's happened in our market, you shouldn't really have a problem of it being worth 380 now.
Yeah. One of the problems, isn't it, is that there's very few people, professionals, that are around to advise the purchaser without a conflict, isn't it? So it really is a matter of looking for an accountant or an investment advisor that is going to give advice that is not fettered by the fact that they are getting a commission for selling the property.
Yeah. I always say to people, look where the money is. If you're paying somebody for a fee for service, then you're probably likely to get more likely to get independent advice.
Well, it sounds to me like that's a property worth holding without any other information to go on. Well, thanks for tuning in. It's time for a break, but when we return, we will answer more of your questions and more emails. To have yours answered, call us now on 1300 30 34 35, or you can email us on property@skynews.com.au. Welcome back. It's been a great night with our experts Damien Collins of Momentum Wealth and Brad Beer from BMT. Well, we've been not so busily answering your phone calls, but we've certainly taken plenty of your emails. If you've got a question, you've still got time to call us on 1300 30 34 35, or you can email us on property@skynews.com.au. And we have a caller on the line, Paul. Hi, Paul. You're from Sydney, I understand.
Yeah, good evening, gentlemen. I suppose my question is, I'm in the market at the moment for my second investment property, and after attending a number of different auctions in the east, I feel as though my gut tells me that it's quite overpriced at the moment. So looking at potentially investing up on the Central Coast around the Terrigal, Avoca or Copacabana area, and just wondering what your thoughts are on the market up there, and if there's much growth you see coming in the next 6 to 24 months.
And Paul, you mentioned that you've been looking at options, did you say in the east?
That's right, Sydney's east, in the Sydney east.
Sydney eastern suburbs. Okay, so Brad, we'll start with you. So Paul's had a look around the eastern suburbs of Sydney, but is now thinking he might be better off on the Central Coast. What do we think about that?
Well, look, Paul, I guess you're being fought out by everybody else in the eastern suburbs, and so therefore looking elsewhere. And look, it's probably not so bad sometimes to get out of your backyard on where you think you're actually, just because you probably know the eastern suburbs and think that's okay. I'm probably with the Central Coast. I know Margaret's from up in that direction and is not necessarily as positive on those areas a lot of the time, and I probably tend to sometimes agree with her based on the fact that it probably just doesn't have enough jobs, and people from there tend to end up moving to Sydney or working in Sydney, so it's got the draw somewhat, but it tends to probably lack some of the infrastructure needed and some of the things needed to help growth. Nothing major happening there. I tend to sort of play with the Hunter a little bit more than I do there, because I think there's probably a few more fundamentals that I like in that area.
Brad, I agree. I think, Paul, you might benefit from having a broader look at things and starting with the proposition as, let's start at the top and work down rather than focusing on a particular suburb for a reason and then moving to another suburb. Let's look at the fundamentals, and Margaret's book about the 20 must-ask questions would be a really good place, if you've not read that, to grab a copy of that book and read about her approach to analysing where you should be investing, because it seems to me that you've gone from a very crowded market to one that's a bit lacklustre at the moment. So I think you need some help with checking your fundamentals and asking the right questions about determining the markets that you're going to be investing in. Well, we've got time for just one more email, and this one is an email from Julia specifically to Damien. And Julia asks, could you please comment on spending a budget of $500,000 on building something brand new versus investing in an established house? So Damien, across to you for the last question of the night.
Julie, good question. So the pros and cons of both. Obviously, if you're building a house, you're only paying a stamp duty on the land component. You're getting more depreciation benefits because you've got a newer property, and you'll generally get a little bit better rental yields. So there's some of the positives of having a brand new property and building something. A number of the downsides are that, again, I don't know the suburb. Property is really a function of demand and supply, and what goes up longer term is the land component value. Now, whether it's an apartment or it's a townhouse fit or a house, there is an implicit land component value, even if you don't actually own much of the land yourself. So what I find is that from a capital growth point of view, the properties that we buy for clients, the older style ones, the established properties, tend to go up a bit more in value because they have a higher implicit land component value, and those buildings do depreciate actually over time. There's a reason that ATO give you those benefits. So without knowing all the facts and circumstances, if you're looking for capital growth, I'd be focusing on more on established property.
Thanks very much, Damien. Well, we're out of time. Margaret will be back in the chair next week. Thank you also to our callers. And this week, the question of the week goes to Christy, and you might recall that Christy asked a question about positive gearing and negative gearing, thinking perhaps she'd made some mistakes earlier in her investing career. If you'd like to email me on yourmoneyyourcall@destiny.com.au, I'll arrange for Margaret to send you your book. Thank you to our guests, Damien Collins of Momentum Wealth and Brad Beer from BMT. You can catch Margaret and I on Saturday for another edition of Property Success, first screening at 9 a.m. and then repeated throughout the day. During the week, you can follow me on Twitter @MichaelTeys. Thanks for being with us. I'm Michael Teys. Until next time, good night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.